Hey everybody, Michael Gold. I'm the president and CEO of Gold Family Wealth, where we help people make smart, informed decisions to improve your life by achieving your financial goals. Now, have you ever wondered how you can build serious wealth? You feel like you're doing all the right things, you have hopefully a good investment program, you're saving money, but you find it challenging to really move the needle to get from point A to point B in a meaningful way. And you see some people out there that just seem to have it like all together and they're just moving leaps and bounds, right? Well, for the longest time, I felt the same way. And then I figured out that it's not that it's easy, but once you find a capable strategy to manage your portfolio, sure, that'll help incrementally grow your wealth. It'll help keep up your buying power, but is it going to help you boost to that next level? And the reality is what I found, but so many other people have learned before me, is that to really go to the next level is how do you reduce your taxes or eliminate them completely legally? And that's the way to really move the needle. So today we're going to be talking about a strategy. It's a more esoteric advanced planning strategy that does just that. I'm going to walk you through from a very high level and I'm going to bring it down to a granular level so it really lands for you. And I'm going to show you how, if this situation is right for you, because it's not right for everybody, how you can really boost your wealth by reducing and in some cases eliminating your taxes. All right, let me pull this up. All right, one second. Okay, here we go. All right, so here's the deal. If you want to build serious wealth, you need to address your taxes and how not to pay them legally, right? That's the key, how not to pay them legally. So first and foremost, what if we told you that you can do this and you still have full control around who you select to manage your money, right? You may be working with a hedge fund manager. You may have a fantastic portfolio manager that's doing this already for you. So what if we told you that you can reduce, or in some cases eliminate your taxes and still maintain the strategies that you want? Second, let me pull this up, your funds grow tax deferred. Now that sounds, you might be thinking, Mike, well that sounds like an IRA. Right, but how much can you put into an IRA or a 401k? Not that much, right? I think it's like around $6,000 into an IRA now, and a 401k is around $19,000, a little bit more if you're above 50. So what if I told you you can put larger sums of money, you still control who manages it, and it grows tax deferred like an IRA? Okay, but that's not all, so let's continue. So now, this is where it gets even better. If it's structured properly, you can access your funds tax-free. So it grows tax deferred and comes out tax free. So I like to think of this as like the Mount Everest effect, if you will. It's kind of like you build and you accumulate, you reach the summit, but most people die on the way down because they don't plan for the descent. Right? There was a famous situation. There was a movie made on that Mount Everest back in 1996. Well, the movie was after, but it was about these two teams that brought these hikers up to the summit, but they mismanaged the time to get to the summit and how long it would take to get down. Long story short, a lot of people died. And if you look back at how many people have died over the years climbing Mount Everest, it's on the descent. So we're going to boost your wealth and reach the summit, but by structuring your distributions tax-free, you can come down smoothly. Okay, so next we talk about there's an additional tax benefit if something should happen to you. So unlike investing your money in a traditional account or an IRA or something along those lines, there's also a benefit, a death benefit, like a life insurance policy that's tied to it. Okay, so now the reality is this. What if you can do this? What if you can have the money managed how you wanted? The money grows tax deferred like in an IRA and comes out tax free like a Roth IRA if, and this is a big if it is structured properly. And in addition to that, there's a death benefit, which helps for legacy planning, whether it's to help your family, charitable intentions, or really whatever your intentions are. So if I was able to tell you that there is a strategy like that, what would you think? Well, if you're like me, most people would say, well, I'd want to learn a little bit more. Okay, I wouldn't want to go blind into that. It sounds great, but I'd need to know the particulars. So let me just pull this up for you. 1 second. Okay. So now I call this the rich man's Roth. All right. And the reason why it's the rich man's Roth, a Roth IRA, again, is like a regular IRA, except you're putting after-tax dollars into it, but you're capped out at $6,000. Rich man's Roth is you can do a lot more. All right. So what this is, we're going to be establishing a rich man's Roth, and I'm going to get into it. And it's designed really solely to maximize the growth of the portfolio by eliminating the tax drag. Now, a lot of people say, well, Mike, look, what is it worth going through all of this? You know, if I'm making money, and I pay taxes, it means I'm making money. I'm going to stop you right now. You can have the most amazing investment strategy in the world. If it's not tax efficient, an amazing investment strategy can become pretty mediocre rather quickly. Think about the long-term impacts of the tax drag and the ripple effect that can have. It acts as termites eroding away at your capital. If you had something that doubled in size, fantastic. You take 30-40% out of that from tax drag, still a good return, but that's off of a double. Think about the more traditional types of returns that are out there. So in a rich man's Roth, and again, it's just a phrase, it's not the actual strategy. I just like to call it the rich man's Roth. We're designing this to boost and maximize your portfolio by eliminating the tax drag. So if you have a great investment strategy, awesome. It doesn't become mediocre. If you have a mediocre investment strategy, it doesn't get worse. Okay, and then next, it's also providing a death benefit. However, this is set up to get the least amount of death benefit for the amount of money that we're putting in. Because again, the main goal around this is to get rid of the tax drag. And this is how it's going to work. Let me pull this back up. Let me blow this up for you. So we talk about, I like to call this death and taxes. So these are the two things that we have certainty around. Now, I've crossed out taxes because I think we've made some headway on this. Death, I'm still working on. So the way that this works is we establish what's known as a private placement life insurance policy. All right, so now this is a life insurance policy, but this is not a retail policy. This is a private placement. It's custom to you. All right, second is the premium, the amount of money that you have invested is going to purchase the least amount of death benefit for the amount of premium. And the funds that you're invested are tailored to your needs, as opposed to there's just a bucket of things that you can invest the cash value in at a traditional retail. If you have a goal for 10 or 20 years and you want an investment design around that, you can pick and customize and tailor that to you. So that's step two. Third, the funds, the premium that you put in, that's the cash value. And if that's invested in your investment strategy, well, cash value in a life insurance policy grows tax deferred. So I want you to think about this right now. If you just invested and you had a portfolio that was just an account in your name or a joint name or something like a taxable account, at the end of the year, you're sent to 1099. That 1099 is going to detail your dividends, your interest, all which you have to pay taxes on, as well as if there was any profit versus losses. And if there was a realized profit, guess what? You have to pay taxes on that too. So here's the deal. When you talk about the cash value in an insurance policy, and because this is private placement, you can customize it, you don't get those 1099s. Okay, it's all deferred, like in a Roth IRA, which is why I call it the rich man's Roth. Again, death and taxes, I haven't figured out death yet, but I've made some headway on the tax side. Okay, so here's the deal. When you package it, in essence, you're wrapping around an insurance policy, in essence, around your portfolio. And this way it grows tax deferred. No more 1099s. No more annual tax bills. You with me so far? Okay. So now let me just go back to this. And the fourth, the distributions would be tax-free if it's structured properly. This is huge. Now, we talked about the Mount Everest effect before, right? We grow it all the way up. Like, that's great. We eliminate the tax drag, so you get that boost to reach the summit. But the distributions, right? As you're pulling money out, we want to eliminate or mitigate that tax so the money lasts that much longer. All right, so you can get all the way up and you can go all the way down, no tax. All right, in most cases, no tax. Again, it has to be structured properly. Now, what does that even mean? Now, let me just go back to this. Let me just pull this up for you. All right. So this is an illustration here. If you look at the structure around this, again, you reached the summit, and now we're going to do what's known as the 4-year rule. Now, what's the 4-year rule? Really simple. If you were going to put a premium in and build out your private placement life insurance policy, you simply break up the premium over 4 years. All right, so check this out. So if, let's say, you had a $20 million premium that you were going to put in, that was going to be the portfolio. Instead of putting in $20 million day one, you do $5 million per year for 4 years. Now, the way that this would play out, really straightforward. Let's just say hypothetically, all right, these are not based on it. This is totally hypothetical, just to give you an example. The $20 million over a certain period of time grew to $80 million. No tax, awesome. And now you reached the summit, you have serious wealth here, and you wanted to start pulling money out. All right, the 20 grew to 80, you have $80 million in the portfolio. You can take your first $20 million out completely tax-free. All right, pretty cool. Then you can take a loan against the remaining 60 million, up to 90% of the remaining 60 million, which means you can take a loan against your own money at very low rates, if you will, again, if it's structured well, for about 54 million. Now, because it's a loan, that distribution, again, tax-free. Pretty cool. So you've captured all of the upside tax-deferred, and you've gotten most of the distributions out, in essence, tax-free. Now, mind you, there are some caveats to that would reduce the ultimate death benefit to the portfolio. But if you're looking to boost your wealth and take distributions for maintaining your quality of life for a long period of time, this could be a really powerful strategy. Okay, now let me just pull this back up here. I want to give you a case study. All right, now this is a hypothetical case study, just so I walked you through how this works from a technical standpoint, but I want to see it in real world action, so you can kind of see how this potentially could play out for you if it would fit. So I'm going to go back to this case study. I call this my friend Jim. All right, my friend Jim's 50 years old. He's got $5 million in a portfolio, and let's say that portfolio's expected return is, say, 8% net of costs. Again, hypothetically, let's just say that's what Jim's expecting. Okay, so now, if Jim is in a 35% tax bracket between capital gains, state gains, ordinary income, the ACA tax, let's just say that grouped up to 35%. Let's say Jim lives in California and there's a higher, state tax rate is there as well. So now what happens is, in 10 years, we would estimate that Jim's portfolio would have gone from 5 million to 8 million. Pretty good. And then in 20 years, it would have gone to $14 million. Nobody's crying for Jim. Now, what if Jim can eliminate that tax drag? What would it look like? So check this out. If we did the same exact strategy, right? He had the same portfolio manager that was running the money before, but we wrapped it in a private placement life insurance policy. This is what would happen. Let me just pull this up. In 10 years, he'd be up to 9.6 million. That's about 1.6 million more. And in 20 years, $19 million, which is $5 million more, simply by eliminating the tax drag. Now, I want you to think about this for a second. If you had the opportunity to do exactly what you're doing now, but earn that much more money simply by removing the taxes, is that something you'd want to look deeper into? Most people would. Now, I have to warn you, it's not for everyone, and there's a few things you need to be aware of before you would even consider doing something like this or even entertaining this. So let me just pull up some of the do's and don'ts. All right. So first and foremost, when you get involved with a private placement life insurance policy, there are additional costs for mortality, administration, as well as some states have premium taxes. So you really need to be very, very well aware of what those costs look like before you even get into this. All right, because in some cases it may not make sense. So you need to know this. It's not just all like it's great we reduce the taxes. It's very, very. It's crucial. You know what the fees and expenses are before you get involved in anything. It has to be fully transparent. Second is the projections that who's ever presenting any type of insurance or illustration most likely are going to be inaccurate. Now, this holds true for when you look at investment portfolios, traditional life insurance, variable universal life insurance, private placement life insurance. They're illustrations. So you want to be very much on point with the illustration to see, is it true to form? In most cases, it's not. So take everything you see with a grain of salt. And if something seems a little bit off to you, like the returns just seem way too high or the projections are linear, meaning they're compounding at the same level each year, those should be red flags. So you want realistic projections. I would opt for more conservative and be pleasantly surprised if they're better. So take those with a grain of salt. And also really must these last two pieces, really important. Government policies can change. Like if there's changes in the tax code, that can, this works now, something can change in the future, and, you never know. I don't know, but it's something to be aware of. Nothing is forever. And lastly, and most importantly, like I said, it's not for everybody. So this is for accredited investors and qualified purchasers. So accredited investors, meaning if you're single, you have at least an earned income of $200,000, you're married at least $300,000 with a net worth of $1 million, and a qualified purchaser, this is really the trump card. You need to have at least $5 million of investable assets, meaning like outside of real estate liquid, for you to even entertain this. So again, can be a really powerful strategy when it works. It's not for everybody. These are some of the do's and don'ts to be aware of before you even entertain going into these. So now, the key takeaway around this, I'm going to blow this up. If you want to build serious wealth, the key is to address your taxes and how not to pay them, and how not to pay them legally. Now, private placement life insurance is one strategy. There's many strategies that you could do. This is one of many that can help do this. Now, it's not right for everybody, but when it does fit, it can be a game changer. So just remember, again, you can have a great investment strategy. However, after taxes, it can become mediocre. So traditional investment strategies will help build your wealth and keep up your buying power. You want to really move the needle, address your taxes and how to reduce them. And if you could really eliminate them in a legal standpoint, even better. This is a great strategy when it works. I hope this message has served you. I hope you learned something new. And if you want to go any deeper, learn a little bit more about this, shoot me an email. If you have any questions, you can give my office a call. I think I have my stuff up here. Let me just pull this up. Hold on. Just quick disclosure. And okay. You can just shoot me an email or give me a call, and either myself or somebody on my team will get back to you and schedule a time. And I hope you learned something new. I hope this message has served you. And I want you to continue to remember, make smart decisions about your money so you can improve your financial life by achieving your financial goals. I'm Michael Gold. Make it a great day.